The sixth and final lesson to learn from market history sounds very simple, but in practice it's anything but. Because once we've put in place an investment portfolio that accurately reflects our attitude to risk, history teaches us that the best thing is to do nothing.
The hardest thing to do is to sit still. One of the advantages to real estate for many investors is that it's somewhat more difficult if you own private pieces of property that don't trade every day to sit still, because it's difficult and expensive to sell them. And I think one of the reasons why a significant number of individual investors have had overall better experience perhaps investing in property than securities is not because property has had higher returns. Oftentimes it's had sharply lower returns, but they've been forced to sit still because people don't come on the nightly news and tell you that the value of your apartment building or your house is down 4.7% today and suggest you ought to sell it and buy it back 3 weeks from now when it'll be even cheaper still.
You know, this wonderful creature that Ben Graham spoke about, Mr. Market and Mr. Value. Mr. Value does all the work. Mr. Market has all the fun. Mr. Market is out there is trying to tempt you every day, wants you to do something, do something, do something. And he's really good at tempting you when things are pretty positive and everybody's excited and it looks like a winning situation to be a buyer, but that's at the highs. And he really tempts you to be a seller when everybody's telling you it's really terribly difficult. The future is not at all promising, and you can see that everything has been going down, down, down in prices. Mr. Market is out there ready to trade anytime you like, and he's going to tempt you. And if you can ignore him and stay instead with the dull plodder, Mr. Value, you'll be much, much better off.
The problem is that we tend to act on our emotions, and men in particular assume that doing something is better than doing nothing. But looking back through history, investors have all too often done just the wrong thing at just the wrong time.
We frequently want to chase something that's been hot. Investors do want to get good returns, and we presume that something that's performing well will continue to perform well. That we zig when we should be zagging. We sell when we should be buying, we buy when we should be selling.
Another drawback with trading too often is that it adds to the charges we pay. Over time, those charges can make a massive dent in our investments.
The job of a stockbroker is to transfer the wealth of the client to themselves. Typically, they extract in the range of 2 or 3% of their assets per year from the clients. And if you do that over a period of 20, 30, 40 years, eventually your broker winds up with more of your assets than you do.
When we say do nothing, that actually isn't strictly accurate, because perhaps once or at most twice a year you do need to rebalance. For example, if equities have had a particularly good run, that may have left you with a higher percentage of your portfolio in shares than you're willing to risk. Or if bonds have done well, your portfolio might be more defensive than you'd like it to be.
I think it's an absolutely critical part of any investor's armoury of surviving market crashes. And you know, in a way, what it is a non-predictive sort of bubble avoidance, because you're effectively selling out of things that have done well and rebalancing back down into asset classes that then subsequently perform badly.
People don't realise how important it is to rebalance a portfolio. The primary reason why you rebalance is because it takes you back to the original risk profile of the portfolio. So you're not doing it to make profit, you're doing it to make sure that your portfolio always maintains the required level of risk that you're prepared to take. But the byproduct of rebalancing to get your risk level back to where it should be actually means that you're actually taking profit and securing that profit.
So there you have it, the last and arguably the most important lesson our experts say investors can learn from market history. Join us in part 8 for a summary of what we've learnt and for a light-hearted look at some of the daftest decisions investors have made over the centuries.